So thank you everyone for joining us this afternoon. You're joining us for a panel discussion on opening up capital access for underserved small businesses. I actually want to take a second and say you should give yourself a hand because you're joining what is going to be the best panel across the entire Milken Institute for three reasons. One, when we talk about opening up capital access for underserved small businesses, within the larger theme of the Milken Institute, building meaningful lives, I don't think a lot of people realize when we're having these conversations of global finance, what percentage do you think of employment is within the S&P 500? It's actually only 17%. So when we talk about building meaningful lives, small businesses are at the cornerstone of that. Point one. Point two, why do we have underserved on the stage? If we go to the slide, I want to point out when we look at underserved markets, minority-owned small businesses in particular, there was a study that was recently released last year by the Institute for Policy Studies. If we can have the slide on the screen there. Between 1983 and 2013, we saw African-American median wealth drop from $6,800 to $1,700 in 30 years. We saw Hispanic median wealth drop from $4,000 to $2,000. That's 75% and 50% drop in median wealth. So if you've got small businesses being a driver for wealth creation and job creation on one side, and you have on the other actually median wealth dropping in these communities, clearly the subject of today in terms of providing small businesses with the resources they need to grow is at the cornerstone of building a meaningful life. So that's why the topic that we're here is rather important. So I'll stop with my soapbox and actually say we're joined on the stage for the third really important reason, probably the best looking panel that you're going to see at the Milken Institute. So I'm lucky to have a couple of really experienced individuals on this field. We've got Mark Robertson, President and CEO of Pacific Coast Financial Regional SBDC on my right, and to his right, Eileen Sánchez, the Director for Small Business Entrepreneurship with the LA Mayor's Office, formerly with the SBA. And to my immediate left, we've got Jorge Castillo with the Maryland Hispanic Chamber of Commerce, and to his left, John Lewis, the Executive Vice President and Chief Administrative Officer of Harbor Bank of Maryland. So what I'm going to do is actually take a second and say, allow these folks to kind of share a little bit about who you are, your organization, and why you're here. So why don't we just start with you, John?
Absolutely. So the Harbor Bank of Maryland is a 35-year-old commercial bank chartered in Baltimore, Maryland. It holds a distinction of being one of only 19 African-American owned and managed banks in the country, and the only one in Baltimore, Maryland. It has a special place in the city. It was literally founded to address issues of capital access, particularly in the African-American community. Baltimore is a city with a long challenge history with respect to kind of racial solidarity and inclusion and equity. And this is a firm that's always been there to do the work in communities that have been struggling to have access to capital.
Yep, Jorge Castillo, President and Chairman of the Maryland Hispanic Chamber of Commerce. We've been around for 30 years. Actually, we celebrated our 30-year anniversary last year. And what our focus is to support the retention, the growth, the prosperity of Hispanic businesses in Maryland and the adjacent regions, and of course the entities who support them. So just because we have Hispanic in our name doesn't mean that we deal exclusively with Hispanic-owned businesses. That would be a little silly. We need to expand the reach, not just to minorities, but to do business within the entire region. And we do that by facilitating connections, by having programs that prepare people for elevating their business to the next step, and by being a powerful voice in Annapolis with our legislators and our elected officials.
Okay, thank you. Mark.
Good afternoon, everyone. Mark Robertson, President of Pacific Coast Regional Small Business Development Corporation here in Los Angeles. We are an SBDC, a Small Business Development Center, in partnership with the SBA. And we're also a community development financial institution a CDFI as designated by the U.S. Treasury, and I'm very happy to say that on tomorrow, it's interesting, the anniversaries we mentioned here, on tomorrow we'll be celebrating our 40th year in business, so we're very, very happy about that, and still around to make an impact. And the impact that I speak of is our borrowers are businesses that have revenues that range anywhere from $250,000 on average to about $1.5 million. Our average loan in our portfolio is about $80,000. And about 60% of the loans in our portfolio are to either African American small businesses or to Latino-owned businesses. So we're very happy with that track record. We're proud to be making an impact in the space that we're here to talk about today, and just happy to share with you as the afternoon goes on.
Eileen, actually, before you go, I'm going to add an extra question on top of explaining who you are and what you're doing here. But since you actually come from the SBA, one thing that we didn't get a chance to mention earlier, so the Milken Institute did a partnership with the U.S. Small Business Administration that launched last year, the Partnership for Lending in Underserved Markets, which really tries to move the needle. So I'd like to actually explain a little bit more why this is such an important topic.
Well, we have, well, first of all, I have to say, it is Small Business Week. So if you did not know, the president since 1963 every year has proclaimed National Small Business Week, and the president gave a proclamation yesterday. So congratulations to small businesses, it's Small Business Week. So it's one of those where after working for SBA for 2 years and breathing small business every day, I have to breathe small business every day. So it's really nice. It's kind of like when your friend has a birthday party, you get to celebrate it for a week, and then hopefully we can extend it for a month. But the aspect of reaching, there's 3 important aspects. It's not just access to capital, it's really access to information, as well as access to capital, and more importantly, access to new markets, and whether that's international or other markets that are within the United States. But if we just focus primarily in the underserved markets, and those are the markets that traditionally lack the access to that information, the access to the capital, and the access to the new markets. And we emphasize tremendously the access to information and how we can facilitate that, and how we can provide and tie in all of the resources that exist at the city, at the state, and at the federal level that are government-funded programs that exist at no cost to help businesses write their business plan, teach them about succession planning, do a SWOT analysis, and there's so many resources out there that exist, and so the access to information is critical.
Yeah, thank you. You bring up a good point in terms of making sure that the success of this is not so much, just pushing capital to small businesses. The success of the small business is what is the measure that we need to do. That being said, there are small business lenders that are out there that are doing the good fight. And one of them, John, is Harbor Bank. And I'd like you to talk a little bit more about the reality on the ground when you're trying to actually bank some of these businesses. What's going on?
Right, so really the issue with capital to small businesses is twofold, right? And some of it is literally capital, right? So you've got to have institutions that are well capitalized, able to provide the right kinds of financing to these businesses. But secondly, when we're talking about small businesses, there really is a need for technical assistance. I mean, it's almost that you have to have an intensive private equity-like model to capitalize some of these small businesses. One of the statistics that's out there is that 97% of African American small businesses do not have a single employee. So if you think about what that means, one, for employment growth. Literally, if you're able to get them to have 2 or 3 employees, that changes neighborhoods, that changes communities. But secondly, if you think about the sole proprietor, they're doing everything. Not only are they doing whatever the core value proposition of the business is, but they're doing the legal aspects, they're doing all the aspects of business that you need, the marketing, all those other things that you need to provide your service and grow your business. So what we find is that not only are we providing capital to these businesses, but we're also bringing our social capital, we're also bringing our connections to these businesses to make that load a little bit lighter in the effort to grow those businesses.
So, but I mean, talk a little bit more about this issue of there's a difference between doing traditional credit underwriting versus
Right.
in this particular sector. It might not be science all the time.
Right. So we are probably one of 2 or 3 community banks left. As I mentioned before, we're at $300 million in assets, and everyone in the financial services industry knows that's a very difficult number to maintain profitability and do the servicing that you need to do in your communities. But we're a bank, right? We're regulated just like everyone else. You know, we've got to have certain underwriting standards. And if you go back to our founding, we were founded, as I mentioned before, to meet a need. And we found over time, because of increased regulations, we just couldn't meet the need in the same way. And we created some other subsidiaries to meet those needs. But you know, banks are banks, right? At the end of the day, you need cash flow, you need collateral, you have to have been in business 2 or 3 years. You've got to really have an accountant. You can't walk in with your shoebox and a good story. And that effectively keeps a lot of businesses that might be able to service a loan out of legitimately being in the banking system.
Yeah, no, he brings up a very good point. So when you're looking at in a lot of these different segments where minority-owned small business is one of the major sources of collateral is your home, and if you were hit by the Great Recession where your collateral was wiped out in certain zip codes and nearly 50% of that value was taken and your credit score was wiped out, essentially banks that are out there that are trying to lend, they're going to have a problem. So we have to be a little bit innovative. That being said, you know, I'd like to hear a little bit from the voice of the small businesses in terms of the Chamber of Commerce. You know, you represent a number of these organizations in Baltimore, the greater Maryland area. How are they able to meet their need?
Well, it's difficult. It's difficult for a number of reasons. The first one is you have to see Hispanics and the evolution that they've had here in the United States. Obviously, New Mexico, California, Arizona, Spanish families have been there for millennia, actually. You know, in Maryland, although the first Hispanics arrived in the 1500s, they didn't quite stay there. But now you're seeing the growth of the population. So in Baltimore itself, the Hispanic population has doubled since 2010. The businesses grew in the last 2 years. Hispanic-owned business ownership grew by 42%. Nationally, they're growing at 15 times any other demographic. So the growth is rapid. The challenges, like John mentioned, one of them is technical. And I also pair the technical acumen of a business with the cultural acumen of the business. Because when you come from another country and you immigrate to the United States, you're not really familiar with a lot of the things. You're not familiar with filing your taxes every year, your tax deductions, the legal and regulatory environment. So we have to go a step further in terms of advising and teaching and mentoring. It's not just your SWOT analysis and your ROI or your weighted average cost of capital. It's the fact that you have to speak English, you have to market to non-Spanish speakers, you have to design your marketing in a way that is appealing to the American crowd. All of those are barriers that keep weighing on Hispanic-owned businesses. Add to that discrimination, which exists. We know that, I'm not going to go into detail, but Google Baltimore lending discrimination, and you're going to find some research that suggests that it is quite alive and well, not only in Baltimore, but throughout the nation. Accessing capital, then the third challenge too is the fact that because of the cultural issues sometimes, you don't build your your American credit worthiness in the way that most Americans would, meaning that people from some Latin American nations see credit actually as a bad thing. If you own money to somebody, it's a problem. You know, you buy things. My parents bought our house in Peru with cash. They saved forever. You know, similar to what they do in Japan. You save for a lifetime and then you buy your house towards the latter part of your life. But credit, understanding credit, familiarizing yourself with credit, and being comfortable with leverage is another challenge. So all of those things weigh into that.
So it's not just about the lending. Clearly, we need to be thinking about the technical assistance that goes along with it. But within this challenge, obviously, this is a costly effort. But I just want to contextualize this a little bit. That the slide that we showed in terms of that median wealth gap, one of the big takeaways from that was in this study was if we don't correct this, we have roughly 200 years for African American households to be able to catch up to non-minority. We need another 80 years for Hispanic American households to catch up to non-minority. So clearly, reversing this trend is a very important thing. That being said, I'd love to hear a little bit about the LA context. We've been hearing from Baltimore. We're in Los Angeles. We're technically, I think this is Beverly Hills, but we're in LA.
It's LA County.
LA County.
Right. The challenges, I think, are a bit different from Baltimore and Maryland in general. I think they primarily have to do with, first of all, geography. Los Angeles County is 4,000 square miles. If it were a state, it would be the 8th largest state in the nation. And the challenge there is finding these targeted populations to do business with, particularly African American businesses. We make up 9% of the population here, only 7% of the businesses that are owned. And the fix for that is what we've discovered at PCR is that we have to go where the businesses are. Where are the concentrations? And most recently, we've discovered 34% of the businesses owned in the city of Compton are owned by African Americans. 54% of those businesses are owned by Hispanic Americans. And the same with the city of Inglewood, very similar numbers, 46% and 40% respectively. So we aim to meet that challenge by going to where the businesses are. Secondly, and Jorge alluded to it as well, I was in a philanthropy session this morning, and one of the gentlemen on the panel mentioned that he who controls the pesos controls the say-sos. And that is true in lending as well. In this context, in my years of experience, I've noticed that the portfolios, the loan portfolios of banks will mirror those that are in control. And the challenge there is that there is not one African American bank in Los Angeles that does business loans. There is only one Hispanic bank that does business loans. So that is something that really needs to be focused on and changed around. And to the extent that that can't be done, and it can't be done in the short run, then we need to focus on the alternative lenders that are working in this space. PCR happens to be one of them, but I can think of 3 CDFIs that pre-recession were up and running and vibrant that are no longer CDFIs or no longer exist. So the natural willingness, the natural infrastructure, if you will, of organizations that are willing to do this work has contracted, and that is something that we work towards solving every day.
So you brought up this point around the recession and I think it's probably worthwhile to contextualize the massive amount of consolidations and mergers that happened in the past 10 years for the banking sector. And as a result of that, we had an exodus of different potential lenders that are out there. And let me agitate the question. There's a whole bunch of online lenders that are out there. Why aren't we using that? What's the opportunity there?
Well, I'll be honest with you. Part of what has happened when you're not that business savvy is you open the doors to predatory lenders, and so a lot of that, and it's not just non-Hispanics doing it to Hispanics; it's Hispanics doing it to Hispanics. They're taking advantage of that lack of knowledge. So that's one of the things that has happened with online lending. On the other hand, I think we have to see it as an opportunity. Fintech is the buzzword nowadays. Getting getting money online should be an easier process. How we get there is I think, the challenging part, and something that's not going to happen overnight. But to answer your question directly, predatory lending is one of the things that have affected our businesses the most. And people have lost houses, they have lost their cars, all their possessions because of those practices as well.
Yeah.
I would agree with Jorge. We probably get 3 calls a week now from borrowers who will come to us after having gone to an online lender or a fintech lender and say, can you help me? Can you rescue me from this loan where my payment doesn't even cover the interest, where the interest, if you look at it, can range anywhere from 20 to 80% per annum. That is what we're seeing from that particular sector, number one. And number two is, I will admit that I envy fintech in its ability to market and to create a backlog of transactions to work on. I envy their ability to make quick decisions, but I wouldn't trade that for the high-touch relationship building that the historic lending model offers, because when the chips are down, when that business is about to go under, it's that relationship that will cause them to want to send in something, even though they can't make their full payment. It might be $50 a month, it might be $30 a month, but it's something that keeps the doors open between them and you. We've even had borrowers who wanted to eliminate our loan from a pending bankruptcy. They can't do that legally, but they've presented that to us simply by virtue of the relationship that we've built with them over the years. So fintech all fintech is not bad, but all of it is not good as well.
I mean, this is an interesting line of discussion, because I think there's 2 potential ways to get more capital flowing. One is to bring a whole new group of actors to start lending in this space. The other is to look at existing lenders in the space and add capacity to them. As lenders that are out on the ground, I'd like to hear your perspective. I mean, clearly we all recognize we need more shots on goal. What's actually needed?
Yeah, so I would say, I'm always expressing, and part of it is self-interest, that there's a value to having bankers, right? So when you look at these small businesses, you would think they would be less complex than some of the larger businesses, and lending to them would be less complex. But it actually can be more complex with respect to understanding them and coming up with the right structures, right? So a lot of times when we see online lenders or other different types of lenders that are non-bank lenders, what they're coming into the market with are standard term sheets with standard terms, right? You'll see things that look like 5-year loans with straight 5-year amortizations on them. And then if you match that to the business, and you match it to the business's prospects and its cash flow, it's absolutely not the right kind of financing for these businesses. So really, these businesses need to be understood, they need to be underwritten in a traditional way, and then they need to have a facility that's properly structured to support them growing. One of the other things that we often look at, especially when you're talking about startups or early businesses, early small businesses, is that loans aren't always the right forms of capital. Now, it's not that there is an abundance of junior and gap kinds of capital in the small business market, but those are the kinds of capital that are often needed by these businesses, especially when we look at things like the $1,500 or $1,700 net worth of entrepreneurs in these communities. There really is a need to give them some kinds of patient money that allows them to have a chance at being successful and growing.
Yeah.
I think, Aron, to answer your question, what is needed, throughout the day in the various sessions I've been to, the word scale has come up in every one of them many times. And so for those of us who are out there in the streets where the rubber meets the road and doing this work that others, for whatever reason, either don't want to do or can't figure out a way to do, then I think it's important for those who have the wherewithal to invest in CDFIs to help them scale. The typical, and there are about 900 to 1,000 CDFIs nationally. The average size of a CDFI is about $20 million in assets. Below that, they're still scrambling around. You've got people wearing 2 and 3 hats trying to get all the work done that needs to be done. So to the extent that we can scale CDFIs to the point where they're at their most efficient capacity, then I think that is something that is vitally needed.
I mean, I find this rather encouraging that you haven't heard one bit of the reference of the word, this is socially responsible or charity. We're talking cash flows, we're talking opportunities, we're talking growth. Eileen, you were at the SBA. What are we missing on this? That this is not a charity case. This is actually growth.
Well, and that's something that was a little bit frustrating because we would often, when we were out there speaking to financial institutions on the importance of increasing capital to the underserved markets, we would get thrown into either the CRA people or the social responsibility people. And it was very difficult to get to the bankers that have the expertise in credit. And so back to what Mark was saying, years ago, and one of our mutual friends, they went to credit training together. So when you see all this bank consolidation, a lot of the banks and overregulation on the banks, they've had to cut back on some of the spending. And so some of that spending has been onto credit training programs, which are the basic element of really great bankers back in the day. And so if you really want to have a relationship banking model, you need to train your bankers on credit. And that's really gone away. There's very few banks nowadays that start training their bankers on credit. How long was your credit training?
2 years.
2-year training. Some banks do it now. They'll do it for a month. They'll do it for 2 months. So there's a fundamental lack of skill set and knowledge on true banking and the relationship banking model. And that was very difficult for us when we were speaking to people because it was just such a sales approach. So I tend to see out there for businesses, who's training these businesses to understand what does a balance sheet look like? What is it to be credit worthy? Once a business is going on the street, I mean, they're there all day. They don't have time when they realize they're in trouble, or they don't know how much money they actually need. And it maybe, like John said, maybe they don't need money at that particular time. And relationship banking takes time to work with them to get them there. And it may take a year, it may take 2. And there's a lot of pressure on the banks for a quarterly basis earnings. So how are we getting that technical capacity building? Again, back to what Aron was saying, how do we get more of that financial literacy that's just beyond the CRA, beyond the social responsibility requirements? How do we actually get more bankers that are very adept on credit? And I worked with very high-level bankers, and if I could just get them out to a high school to speak to the parents of the African-American kids, of the Hispanic kids, and teach them, here's your basic budget for a month. Here, you're coming up to Christmas. Do not go buy a Tahoe. Do not go do certain things. These are the basics of Finance 101. This is what a credit score looks like. So it's really a grassroots approach, especially for us in LA with the different pockets that we have, and reaching into those pockets and knowing where we disseminate the right information and how we get that in. And I think there's just much more, if we want to use the responsibility, there's much more responsibility that bankers need to take to get that information out.
Not just responsibility, but this is actually where the future unicorns are going to come
Absolutely.
from. At the end of the day, if you're looking at majority of job growth coming from that sector and where the baselines are, if you're looking at where are the opportunities, you have to look at this segment, and we're missing the boat. Traditional bankers are missing that boat. So here is, if you're talking about not just building meaningful lives at the individual level, but at local economies in the cities that we all are into, it matters. And that being said, I do want to shift a little bit and talk, the flavor of the month with the new administration is definitely this issue of regulation. Do we have the right regulation that enables a number of the things that we're talking about? I'll throw it out to the panelists. We spotlighted in our exercises a number of things from CRA, reporting requirements, looking at other things, including the support that the Small Business Administration actually gets to mobilize capital. I was happy to see the new CL that was signed on Sunday actually increased funding to some of the things like the CDFI fund and other things. But in the absence of that, there was a statistic that was actually shared during that White House convening that we had last summer, that at that time in June, there were something like 65 months of consecutive job growth, so an up market. But the SBA shared that due to certain issues, we had a 91% drop in SBA lending to the African American community. So it was a drop not in a down market, it was a drop in an up market, which says a lot. So I'd like from the panelists to hear, on the policy side, what do we need to be doing better?
So I'll start. CRA has been mentioned a couple of times, and it's come up on its 40th anniversary. But the truth about CRA, from a practical perspective, is that it really has no teeth unless a bank is looking to do a merger or otherwise is running into some kind of difficulty. And that potentially, if done right, is a really powerful vehicle with respect to getting capital to intermediaries, whether they're CDFIs or other intermediaries. They can use that capital to get it into the hands of small businesses and real estate development in a productive way. So certainly reevaluating CRA and making it more powerful would have an effect on getting capital into urban communities.
I would agree. I think strengthening certain regulations, particularly CRA, would be a benefit. I was at a similar meeting at the Federal Reserve last week, and and I had to compliment the Fed because it's that regulation that had the room full of bankers. Without CRA, the room would have been empty. So I would think that certainly strengthening that would be something that would be warranted. Also, I think rolling back things like CFPB is a mistake, and to the extent that those types of cuts and eliminations happen, the numbers that you read earlier will be worse. And I think in terms of the quality of life of particularly these two targeted populations will be worse.
Sure.
And I continue to think of, the unintended consequences of regulation and what it does to financial institutions and what it does to the people that need to meet, metrics on a quarterly basis. We're a democracy. We're the United States of America. We're a free market, and so accordingly, our private sector has, banks have goals. They have metrics that they have to meet, and so. Sometimes there's just unintended consequences to certain regulation. We having to do all the burdens and paperwork for Dodd-Frank, that just kept us indoors longer. So if we want to change our model on how we serve the grassroots and how we serve the people out there, we really need to think about how, what are the unintended consequences of the regulation we're throwing out on the financial institutions, and then you see all the predatory lenders that are out there on our businesses that are charging up to 96% interest, is last I heard. So how do we actually do something around that? So if we want to make sure that there is disclosure around the rates for businesses and that they know what they're getting into, because as far as I'm concerned, there's nothing there yet.
Yep. Good. Well, I actually want to open this up to the audience because I think we have quite a few folks in the group that are both small business lenders, small businesses, tech companies that are looking at providing capital, and CDFIs. So this is supposed to be an open dialogue. I'd like some interesting questions. Can we get a microphone? And please say your name and your organization.
Garrett Smith from Community Capital, and this is for the community bankers. My question is, if you are banking, let's say, a high-growth enterprise, you mentioned you have a $300 million balance sheet, and maybe they have some capital requirements that can't be met with your current infrastructure and your current size. What sort of mechanisms do you have in order to meet those capital requirements from the companies, and is this something that you face frequently?
Yeah, when you look at the structure of our business, again, going back to the history of the organization, we really needed to be everything for our customers. So not only do we have this core banking enterprise, but we also have a community development corporation, which functions a lot like a venture capital firm, if you will, but also can do some gap and mezzanine type financing. But even more than that, banks historically haven't provided advisory services because of lender liabilities, which is basically to say if I give you a loan and then I tell you how to run your business, you can say, well, I'm not paying you back when the loan goes sideways because I told you how to run your business. Our community development corporation performs an advisory function, and it really is about access to capital. So we're almost indifferent as to whether we're providing our own capital or we're connecting a business to capital. So we have any number of partners in the market and outside of the market, and we know what we do and we know what we don't do, and we know how much powder we have and how much we don't. But in that advisory function, we're working with businesses to figure out where they're going and what their needs are, and where we can play in that, we play in that. If it's bigger than what we can do internally, we'll club a deal, we'll join with other banks, and if it's a different form of capital, we'll bring that to the table.
I would say to that question, actually that is a measure of success for us, to the extent that we can grow a business to the point where they are ready to graduate from our services. We've got any number of banks, at least 40, that we can call on that are much larger than we are, that can meet those capital needs. So besides getting them the initial financing, job creation, and seeing them through to their growth stages, a graduation is another measure of success for us.
Great. Question right in front.
Hi, my name is Karina Morga. I'm also with the Maryland Hispanic Chamber of Commerce. As a small business owner, I wouldn't say that it's been difficult to get access to the capital. On the flip side to that, it's been okay, like with the fintech, if you get a loan, I got a decent rate. It was, it was deposited in my bank, and I was like, wow, my bank account has a lot of zeros in it. Now what? And I think that that's also integral to like these programs that you guys have and everything, these initiatives that you guys are doing, is because if you don't know how to manage the money and you're not guided, most small businesses can't afford a CFO. We know how to run as an entrepreneur, as a business owner, you know how to run your business in different aspects in terms of you got to manage the cash flow, you have employees and managing that, you have HR, you're dealing with so many parts of it, and as a small business owner, you don't have that somebody to come in and say, okay, here's $250,000, this is how you're going to manage it to get to B. Does that make sense?
Yep.
And I think that is a conversation that needs to be highlighted, brought to the table as well.
And your comment really underscores something that we think about constantly, right? There is a real responsibility to the work that we do. Anybody who's been a lender for any length of time is going to structure a loan where they're going to get their money back. Right. They're going to get their money back. That doesn't mean that you're not going to be ruined when they get their money back. And there's just been too many historical examples, certainly in Maryland specifically, if you look at the mortgage crisis, right? There was such liquidity in the market, people got loans, ultimately the banks ended up okay, but you've got people that will have that legacy of wealth destruction. And we're talking about a community where the median net worth is $1,700, right? And that's $1,700 for African Americans who've been in this country for 400 years, right? So destroying any amount of wealth in the African American community with indiscriminate lending is something that we really have to be focused on and how we do that. And one of the things that highlighted it, I think in some of the initial conversations we had, there were people during the election coming into the market and saying we're putting hundreds of billions of dollars into places like West Baltimore, when really if you size the market, there's no way that the market could eat anywhere near that dollar amount, right? But you could put it in there, and you'd have part of a city that would be destroyed for 100 years, right? So that's another one of the considerations we have when we see new lenders popping up in the market.
Thank you, John. You're bringing up the point of there's definitely a point around responsible lending that needs to happen. Last thing that we want to do is overlend and overcapitalize to the point where there is failure and an even further reduction in the remains of whatever net worth there was. We have another question in the front.
Thanks. Frank Altman with Community Reinvestment Fund. We are a CDFI. We support other CDFIs in lending throughout the country. It seems to me that the biggest problem that we face in this effort is not debt capital, it's equity. And I'd like the panel to talk a little bit about ways in which we might think about helping businesses crowdsource equity. The problem with small business generally is the business is funded by the founder, by home equity loans, if you will, friends, family, and fools. And how do we get the fools? I mean this in a good way, but people who want to see communities thrive, how do we get vehicles that will allow them to actually provide the equity that's necessary for businesses to be able to grow? Because a lot of them are just, they're stuck. Any thoughts on any panelists there?
I'll start with this one. I have an idea based on some experience when I was the entrepreneur in residence at the Emerging Technology Centers, which is an incubator. Baltimore City provides most of the funding, but then we figure other ways to get the money in. One thing to note about incubators is they have to be a private-public partnership. You can trace incubators and when they pop up when the economy is doing well, and they start popping up everywhere, right? The economy starts downward trend, and all of a sudden they're gone. And why? Because when you're an entrepreneur, you don't have money. And sometimes you can't even pay the rent. Sometimes you can't pay your electricity, even in an incubator. And that's where science and art come in. We have to understand that if you're a small business, there's going to be some times when we're going to have to give you some slack because we actually believe in you. We believe, we don't believe in the horse, we believe in the jockey. Your business model may be great, but it's going to be the person riding the horse, the person riding the carriage, if you will, that are going to make that business go forward. If you start these kinds of incubators that address these problems, and you start focusing on the top 2 or 3 things that affect underserved communities, primarily African American and Latinos, there's also women and veterans and disabled veterans that would fit there. I think you could start coming with the solution to equity, which means that business will eventually grow. As John mentioned, I think you said 95% of African American business are sole proprietorships. So it's almost the same in the Hispanic community. More than 50% of them in the Hispanic community have less than 5 employees. And what happens is when you're a sole proprietorship, you don't grow and your equity doesn't grow. If you have a bodega, your 5-year plan should be to have a bigger space first and maybe to open an adjacent restaurant and maybe to move to another county and to grow, right? And incubators that focus on that would be one way that I would address the equity issue.
I'm just going to touch on this because since it is a global conference, part of it is also cultural. There are countries around the world where equity is not even allowed or seen, like Italy doesn't allow it. There's a stigma in the Hispanic population. You don't want an owner unless you know who it is. But more than anything, there's just a lack of global connectedness at the startup and small business level. So we need, it's amazing. We're like a global economy here in LA, for example, but it doesn't mean that the startups and the small businesses are globally connected to international investors. There's other cities around the world that have figured out how to do it a little bit better, and we need to start internationalizing our startups and small businesses so that they think beyond just the local, selling to the local economy, which touches on my third point of getting our businesses into new markets and how do we get investors from foreign countries coming in from, from other areas, and not having our startups just think local, think global. And I think that's really important as we see that expansion and try to break out of those stigmas and get it in a long-term plan to spread out a bit.
I think certainly we are not in a position to provide equity. I think a lot of that is determined by the type of capital that we can attract, which itself normally is debt. But what we have figured out is a way to structure debt to almost look like equity, to provide a little bit more patient capital to the transaction that might get the borrower 80, 85, 90, in some cases even 100% of what they need, and structure it with interest only for a year or longer if need be. But we've looked at that. It certainly is a space that we would want to play in, but to the extent that we've got capital that is itself debt, we've got to work within the parameters that we have. But I wanted to get back to the point about technical assistance. Basically, you've got all these zeros in your account. Now what? I mentioned that we are a small business development center in partnership with the SBA. That means that basically we are the technical assistance arm of the SBA, and there are centers like ours nationwide, and we provide both classroom training and one-on-one counseling. And that one-on-one counseling is where you find out what to do with all the zeros and how to manage all the zeros in your account, where you find out about how to do a marketing plan, how to understand all the legal aspects of running the business, how to even read your financial statements, what not to do on your tax returns. So, and that one-on-one counseling, by the way, is free. So to the extent that borrowers want to take advantage of that, all they need to do is go to their local SBA office and they'll find the nearest SBDC.
And in the city of LA, it's very unique because we have what's called LA Business Source Centers, if you've heard of them, and it's the same model, but their requirement is to help the underserved market and help impoverished areas of Los Angeles. So that's really their niche, and that's what they do. And it's free one-on-one counseling, capacity training, and if they find that you are ready for capital, they'll help you package your loan, all for free, and it's part of just the service that the city provides.
If I could just comment. So there's parts of crowdfunding that scare me. The unaccredited scare me, right? Trees grow to the sky, right? Every business is a good idea. The other thing is just valuation, right? So, these 97% of businesses with no employees or small businesses, it's just very hard to figure out what they're worth, right? And then even if you do that and you make some significant capital investment, then you own, some part of the business that probably isn't defensible as a small business. So what we've found is we've had to do everything from royalty agreements to preferreds and other things that aren't pure equity, but are patient enough and provide that slug of capital. But again, for me, there's just such a value to having an intermediary in there. One, for the technical assistance aspect, right, but also so the capital is right. I mean, if you look at these businesses from an operating risk standpoint, they have the most operating risk. So it's important that you're not layering on a bunch of financial risk with these businesses as well. And often we don't do that often. We just give them, some kind of loan capital that doesn't pair well with where the business is.
You bring up a good point. Essentially, clearly, whether you're looking at debt or equity within a business plan of success, you have to manage against the obligations there. And in a lot of these small businesses, sure, it's a mom and pop. You're not going to find a venture capital firm that's going to look at helping a neighborhood grocery store. But there's actually a big reason why patient capital for that type of business actually is helpful. So one of the things that we're trying to do with the Partnership for Lending in Underserved Markets is actually carve out a stream of work that's all about investor capacity, both from the debt side as well as the equity side. And there, we're looking at innovative structures where we're dispersing risk from different partners to move potential capital out the door. So that is one of the things we're going to be working on as part of this 2-year collaborative effort. Question in the back.
Thank you. I'm Eric Mundugu. I'm from Rwanda. I work for the regulator of the securities market, and I'm one of the IFC and Milken Institute fellow. I like the point that you touched about the incubation and the technical assistance that is provided to these small businesses. And my question is, since the panel is kind of made of players that are in the ecosystem that allows these small business to raise capital, what is your role in terms of making these small business upgrade in terms of, because they reach at a point whereby they have grown, they need now more capital and long-term capital, and sometimes it requires them to migrate to the public placement, like the public market, raise maybe debt at the first point and later on equity. So I would like to hear from your point of view, what's your role in bridging the gap between this private placement where you are helping them, but at some point they need more and long-term capital that is provided by the public market. And SBA also, I think it plays a critical role, and I know one or two panelists worked with SBA. So how do you see SBA role in that perspective?
I mean, thank you for making that point. Just as a statistic, I think it's 87% of job growth comes from the SME sector globally. So this topic is definitely we're looking at the cities of Baltimore and Los Angeles, but this is a global topic to your point. But I'll let others answer the key question.
Well, I have yet to have somebody graduate to the public market, so I really don't know how to answer your question. I think it gets back to the issue of us supporting a client until they're ready to move on from us, graduate, if you will. And at that point, we introduce them to the traditional financing market, which usually involves a bank. Beyond that, we're pretty much out of it at that point.
You know, I think you said something that was really important. You used the word ecosystem, and you know, there's every market has a different. You know, the idea of entrepreneurship is something that everybody knows about, but the idea that the recipe is much more important than, you know, the entrepreneurship concept is fairly new, and you know, that's something that our friends at Kauffman Foundation have been speaking on for a while. And it's the idea of knowing in which local market, who are the ecosystem players, and how do we talk to each other at different levels of where a business is. And so once you start to build your ecosystem, which can include institutions, you know, the academic institutions, in their case, they're not an SBDC that's at an academic institution, so it allows them a little bit of wiggle room. But in other cases, the SBDC isn't an academic institution. And then there's economic development centers, and then there's, you know, the public sector players, and then the bankers. And so how do we all talk in individual local ecosystems? And in the case of LA, sometimes it's even tinier ecosystems within Los Angeles because of the pockets. And so knowing where those are, I think is really important, and that's you know, a good recipe.
We have a question over there.
Jen Price, Calvert Foundation. It's a little bit building off the last two questions, but curious how you work along the continuum with each other. So for an entrepreneur, I've witnessed it's very difficult to know where to go for what type of capital, and it's like Swiss cheese, they fall through often. And so do you feel responsibility at times to look outside of your own business and think about how do we create an ecosystem that is easier to navigate? Maybe it's bringing in technology to front-face entrepreneurs to help sort them into different products that are appropriate for their business model. But how are you thinking of that to really create more efficiency in the marketplace?
I mean, I'll continue to take that. I think that that's the really important piece of building the right ecosystem and the strength within the ecosystem. You know, the mayor just hosted yesterday every single small business development center in the entire LA region. outside of the city of LA. So hosting all of them in one place, all these SCORE chapters, all of the LA Business Source Centers, bringing in our incubators, and all the heads in one room just to teach each other what is it that we're doing. So keeping a consistent internal, we call it, training the trainer, and training the trainer and keeping that consistent and following what we call a no wrong gate approach. And it really is a consistent process that's required, again, as training gets cut in different areas. How do the players in the ecosystem talk to each other, and how do we build that? So it's a never-ending pursuit.
I think for us, if I'm understanding your question properly, you're getting at collaboration. And for us, we always look for opportunities to work with either the mayor's office or other CDFIs. A perfect example of a recent collaboration will allow us to open a satellite office in the city of Compton because a CDFI is developing what's called a Center for Sustainable Communities. So we will be taking space in that center. We'll be the only small business development organization in the entire city. And that particular CDFI is involved in low-income housing, but they're bringing us in as a small business entity. They're having another nonprofit that will provide youth services. They'll have another nonprofit that will provide a clinic on site. So we look for opportunities like that to collaborate and work across different sectors.
Yep, thank you. So right before we cut off this panel, I will ask the final question. So the theme, again, for the Milken Institute Global Conference is building meaningful lives. I want to say clearly at the heart of it, having a productive life will lead to so many things that would be important, not for the individual, but for the community and the country and the world at large. And jobs are at the heart of what is the key benefit of a small business, and in the minority community, key. Today, we had, or it was yesterday morning, we had one session that was called the Capital Markets Roundtable. In that one room, there were $13 trillion worth of assets. So with that being said, the amount of resources that are here, and we're talking about mobilizing resources, what's your ask to the $13 trillion worth of resources that are out there? What do we need to do to make sure that we have what we need to grow these small businesses?
Well, I would go back to the issue of scale for those of us who are in the marketplace doing the work, whether it's a community bank, whether it's a CDFI, to the extent that investments can be made, and not just loan capital. In fact, our organization has more loan capital now than it has ever had in its 40-year history, but capital to scale up, to bring on bodies, to properly deploy the capital that we have. That's the kind of help that is needed, I think, if we're going to really tackle this work and move the needle, as is said.
Human capital in these institutions.
Absolutely.
Yep.
I see it as a world hunger problem as well. There's plenty of food in the world. There's people dying of hunger every day, literally dying, because the food doesn't get to them. And I would see, especially within the Hispanic community, growing at the rate that it's growing. By the way, the Hispanic growth accounted for 54% of United States population growth from 2000 until 2010, which I believe was the last census done. When you have that much growth, investors have to really think about the word investing. And it's not just investing in a business, it's investing in the community. Because if you don't, they're not gonna make it. We have to put a little bit more pressure, especially as minorities, and raise our hand a little bit more so that we are included. But you see me here sitting on a panel. I don't represent the average Hispanic business in Maryland. I just don't. You know, I have two undergrad degrees and an MBA, and I've been blessed to be in this situation. The reality of most, small Hispanic businesses is they're not at that level, and we're not talking to them. You know, we're not getting their input. Some of them don't even speak English that well. And so from the top down, from the mayor of Baltimore to the mayor of LA to the investors to the people who have the $13 trillion, you really have to get to the very, very, very core of this issue, and understanding that means talking to the right individuals.
That's a key point. And I do want to say we're almost out of time, but you bring up a point that including the small business in the segments. Final words, 30 seconds or less, please.
So I would say support minority depository institutions. In Baltimore, as a city, it's 63% African American. There are 7 African American bankers that are senior vice presidents or above, and 4 of them work in my shop, right? And one of the things that we didn't talk about on the panel too much is that trust is a real issue, and it's a real issue for good reason, because these communities have had a depth of experience, right? So if you don't have bankers with the cultural competency to go into neighborhoods and work with these businesses, the capital will never get there. And minority depository institutions and CDFIs are uniquely positioned to be able to distribute to these communities.
Deployment.
I'm going to say training. And I continue to believe that that is absolutely important, especially in California, for us to get a lot more credit training out there, a lot more information to the basics of how to manage your banking relationship, how to manage your balance sheet, and get just a lot more out there into schools, churches, grassroots approach.
Thank you, everyone. I'd like to give a final hand to all our panelists as well as our guests in the audience. Thank you for joining us, and enjoy the rest of the Milken Conference.